Rupee today hit another all-time low. This at a time when inflation remains a concern. The Reserve Bank of India met today as part of its three-day meeting on the monetary policy and is facing a twin challenge of the falling rupee and possible rising inflation once again. What will happen? Remember, in that meeting, at a time when the Reserve Bank has been tasked to ensure that retail inflation remains at 4%. Will interest rates be hiked? And how does the RBI deal with the falling rupee that closed today at 81.94 against the US dollar, but doing better than other currencies? So what lies ahead then for the falling rupee and also, yes, for rising inflation as that RBI committee meeting begins? Joining me now is Dr. Sajjid Chinoy, JP Morgan's chief India economist and also part-time member of the Prime Minister's Economic Advisory Council. Dr. Chinoy, the rupee once again continuing with this consistent depreciation, reaching a new low today. How worried should one be?
Rajdeep, I think one needs to understand what's happening globally. We're seeing market movements that we haven't seen in decades over here. And the genesis of all of this, Rajdeep, is that the US Fed is on course to raise interest rates to, close to 5%. The last time this happened was 2007. An entire generation has grown up with, zero interest rates and low for long. This is brand new phenomena. Now, what higher US interest rates do is suck away capital from all economies towards the US. And therefore, many currencies are in a tailspin. Just to put this in perspective, the euro is currently today at the lowest level since 2001. The British pound is at the lowest level in more than 5 decades. The Chinese yuan today was at the lowest level since 2007. So this is a phenomena that's affected all currencies, both advanced economies and emerging markets. India is no exception. We will be at the receiving end of the shock. And I think prudent macro management would suggest that we don't resist this beyond a point. A calibrated, gradual currency depreciation actually is a good safety valve. It's a seatbelt against the shock and will ensure that at the end of this process, India's exports are not uncompetitive. So this is a necessary, response to unprecedented global market movements in the last 2 decades.
But having said that, as you rightly said, the rupee seems to be doing relatively better vis-a-vis the dollar compared to other global currencies. But how far can we go in protecting the rupee? Where can, is there a point at which we should be worried in allowing the rupee to find its own level in the times that that we are?
So Rajdeep, one thing is that the future is very uncertain because all of this will hinge critically on what happens to the US Fed. If the Fed were to remain hawkish and keep raising interest rates, till the first quarter or second quarter of next year, we need to be realistic that the pressure is going to sustain. If, we get lucky and US inflation begins to turn down, the US labor market begins to soften, and you see the Fed becoming a tad dovish, this could reverse in a jiffy. But we can't be relying on hope and luck. Now, if this process is going to last for months and quarters, one has to be realistic about what the options are. There are 3 options here that India has when faced with strong capital outflows. One is to take some of the pressure on this war chest of foreign currency reserves that we've built up in the last 2 years. And that has been the preferred option of the RBI over the last 6 months. But you want to be careful not to run that down too much because you want to preserve ammunition if this shock goes on for another 6 or 12 months. The second option is, if you want to prevent a faster drawdown of reserves, is for the exchange rate to become the shock absorber, to become the adjustment mechanism. And the third mechanism to guard against this is to ensure that the interest rate differential with the US doesn't narrow to very low levels. If US rates are going up, we've seen interest rates around the world will have to go up. And this week when the MPC meets, I'm sure this will be a factor. So expect that interest rates will also go up. So the shock will have to be absorbed across these 3 instruments. Higher interest rates, a weaker rupee, and some running down of reserves. If you rely only on one instrument, that may be imprudent.
Because the RBI is meeting even as we speak over the next 3 days, you're saying likely, therefore, get ready, brace yourself for higher interest rates come Friday. Am I correct?
That's right, Rajiv. There are no easy policy options in a very hostile global environment. The fact is, emerging markets like India that are commodity importers are facing a trifecta. Higher global rates, the strongest US dollar since 2002, and while commodity prices have corrected some, and that's a source of relief to India, they're still elevated to compared to where they are next year. Now, in that backdrop, inflation could still remain sticky in India. The good news is at the margin, we're seeing inflation pressures on a momentum basis have softened in the last 3-4 months, core inflation. So the fact that global commodity prices have corrected, the fact that core inflation has gone down, the fact that inflation expectations appear to have peaked will give the RBI some relief. But the fact is there are new food price pressures because the monsoon wasn't particularly evenly distributed. And inflation is expected to remain above 6%, which is the RBI's upper tolerance band for much of the next 2 quarters. Remember, monetary conditions in India are still very accommodative. Policy rates are at 5.4%, inflation is running at 6%, negative real rate. And in such a hostile global environment, we can't be running negative real rates. So I think we should brace for the fact that very accommodative monetary policy, which was necessary in the pandemic, now has to normalize as the global cycle has turned.
But you said that inflation is softening at the margins, but it still remains presumably a big concern. And if, because of inflation, interest rates go up again, growth gets affected. It almost seems, therefore, that while there is an element of macroeconomic stability, there are major concerns that still remain, at least in the near term.
Well, there's no question about that, Rajdeep. I mean, most economies around the world will have to choose between growth and macro stability in the near term. There really is no trade-off, because if you want to protect medium-term trade-off, because if you want to protect medium-term growth, you have to protect and preserve macroeconomic stability in the near term. Now, what does that mean? It means that our external imbalances, our current account deficit, will have to be brought down. The fiscal consolidation process that has started will have to continue. Monetary normalization will have to continue. This is going to extract some toll on growth going forward, and we need to be realistic about that. The good news is the last 2 quarters, as COVID has receded, we're finally seeing a more durable and sustained opening of the non-tradable sector. The services economy is recovering, and that's a good tailwind to have. But realistically, going forward, there'll have to be some growth sacrifice now in a global storm to avoid a larger growth sacrifice later. And I think that's something that all countries will have to brace for and be realistic about.
So one of those X factors also is the fact, you mentioned the Fed, but the reserves have dropped by almost US dollars 80 billion since the escalation of the Russia-Ukraine tensions. The Reserve Bank constantly intervening in the forex market to cushion this fall in rupee value. Is that also the X factor, that the longer the war continues, that will again remain a concern, because India can't avoid, in a way, not suffering if global economies remain in recession?
That's right. We live in the same world. We're going to be affected by the same dynamics. Now, the good news is, compared to a decade ago, for example, India still has a war chest of FX reserve that was, I think, prudently built up in the last 2 years. Most economists would look at reserves as being a function of number of months of imports. Back in 2013, it was 6 months of imports. We're still at 9 months of imports. But yes, a significant amount of reserves have been used, which is exactly why we cannot be relying only on reserve drawdown. We have to understand that to protect these reserves for a longer time, the rupee has to be the adjustment mechanism. Also remember, if the rupee did not adjust and other currencies weakened, then in relative terms, India becomes stronger, which is not good for the economy. That is going to hurt exports going forward. That is going to make imports cheaper and hurt import competitors. And that's going to hurt growth and hurt jobs. So I have been arguing for the last 6 months that a calibrated, gradual, weaker rupee is actually good for India's growth and job prospects. And it lets off some steam in the external sector. Let me just add one more thing. Last year, we grew at more than 8.5%. 3 percentage points of that came from strong export growth. Now, because the global economy is slowing so much, we won't get those export tailwinds. which is why ensuring that our currency remains competitive is an imperative.
So therefore, in net, if I were to ask you to give us a near term, let's forget about the long term at the moment because we don't know what will happen in the long term. But in the near term, next 3 to 6 months, will we be in a better place in your view? Or do you believe that there are still serious headwinds that we have to confront?
I think if one is realistic, given how US inflation is panning out, the next 3 months could pose a lot of or create a lot of headwinds for all emerging markets around the world. If the Fed continues to raise interest rates and we have these outsized rate hikes from all advanced economies, the Fed, the ECB, the Bank of England, we can't escape the impact of that. I think the message has to be, for now, hunker down. Hunker down, focus on macro stability, get through the storm, and then we can revisit growth prospects on the other side of that.
Dr. Sajjid Chinoy, for bringing so much of clarity to a subject that I know our viewers would be interested in without knowing really the complexity of it. You've really simplified it for many of our viewers. I appreciate you joining me there. Thank you so much.
Pleasure, Rajdeep.